Hello, good evening everyone. Good evening. November 2020 paper, we have in the previous two classes we have solved 1A, 1B, 1A, 1B of the recent paper. Now look at 1C. 1C, value at risk, very small concept. Value at risk, very small concept. Okay, the bit analytical paper. On Tuesday, on Tuesday, this is 1C. This is 1C. On Tuesday morning, before opening of the capital market, an investor, while going through his bank account, has observed that an amount of rupees 7 lakhs is lying in his bank account. This amount is available for use from Tuesday till Friday. The bank requires a minimum balance of rupees 1000 all the time. The investor desires to make a maximum possible investment where value at risk should not exceed the balance lying in his bank account. The standard deviation of market price of the security is 1.5% per day. The required confidence level is 99%. Given standard normal probabilities, also, you are required to determine the maximum possible investment. This concept is related to value at risk. This concept is related to value at risk. Now, before going to the value at risk, we have to understand what is meant by this standard deviation. What is meant by this standard deviation? Okay. Right. Look at this standard deviation. Look at this standard deviation. First, we have to start with the problem with the standard deviation 1.5% per day. 1.5% per day. That means the stock price may fall 1.5% per day. The stock price may fall 1.5% per day. Okay. Deviation from the normal investment amount. Deviation from zero. Zero means no profit, no loss. Zero means no profit, no loss. Remember, this value at risk calculations uses jet table. Jet table uses mean as a zero because it is a standard normal distribution. Okay, not the normal distribution. Jet value calculations are based on standard normal distribution, wherein mean value is equal to zero. Zero means no profit, no loss. Zero means no profit, no loss. From 0 to minus 1.5%. That means I am getting a loss of 1.5%. Okay. From 0 to my 1.5% less than 0. 1.5% less than 0. That means I am getting a loss of 1.5% less than 0. That means 0 minus 1.5. 0 minus 1.5, I'll get 1.5 loss. 1.5% loss. That is what the standard deviation indicates. So the standard deviation indicates that my stock price may fall by 1.5% per day. My stock price may fall by 1.5% per day. That is what the point. Is it the case that every time whenever the stock price is falling, is it the case that every time the stock price is falling only 1.5%? Have you not seen any case where the stock price is falling more than 1.5%? Yes. There may be some bad situations where the stock price may fall more than 1.5%, or there may be good situations where the stock price may fall less than 1.5%. It is not that always my stock is falling 1.5%. There may be some cases my stock price may fall more than 1.5%. There may be some cases my stock price fall less than 1.5%. That is what the case. Now we have to identify what is the chances. What is the chances of my stock price falling more than 1.5%? That is what you have to identify. So normally standard deviation will be fixed. So normally 1.5% is the standard. It's like an approximate figure. It's like an average or approximate figure. It's like an average or approximate figure. It's not accurate. That always this figure is not applicable always. This figure is not applicable always. This figure is a standardized figure. Most of the cases it will be applicable. Most of the applicable. But there may be some cases. Most of the times this is applicable. So that most will quantify it now. Most of the cases, this is the point. Not always. Standard means for your simple layman language, I'll take most of the times. Most of the times 1.5%. Sometimes more than 1.5. Sometimes more than 1.5. Sometimes more than 1.5. What is that sometimes? How many of these sometimes is our question. Sometimes more than 1.5. How many of that sometimes? How many times we are having more than 1.5%? There is a chance. So most of the times my stock price is falling 1.5% per day. Okay, but there are some times when my stock price is falling more than 1.5%. Now this problem we are focusing on how many times the stock price is falling more than 1.5%. Okay, right. How many times? This is the one standard normal distribution. One standard normal distribution is equal to 1.5% per day. One standard normal distribution is equal to 1.5% loss, or less than that, or less loss, 1.5% loss or less loss. So sometimes my loss may be more than 1.5%. That we have to understand. That we have to understand. Look at this point. I'll show you the jet tables. Then understand. Jet tables will understand. Right. So if you look at the jet tables here, okay. So first, if you look at this point, first we'll start with this one. One. So one. So that means normally I thought 1.5%, standard deviation. That is a normal case. So if you look at this 0.843, what does that indicates? That indicates that 85% of the times, 85% of the times, loss is 1.5% or less. 1.5% or less. So 1.5, normally if my loss is 1.5%, some cases my loss may be more than normal loss. Normally I am losing 1.5%. So in extreme cases, I may lose more than that. I may lose double. Normally I am losing 1.5%. Sometimes I may lose 3%. That means what is 3%? Twice than the normal loss. What is 3%? But twicer than the normal loss. Twicer than the normal loss. Look at this two. This 2 stands for twicer than the normal loss. Normally my loss is 1.5%, but sometimes I'll get twice loss. Now I'll get twicer than the normal loss. What is that? What is that below 97? That means there are 3% of the cases my losses are double than the normal losses. So that 2 and 0.97 indicates that this 2 and 0.97 indicates that 3% of the times out of 197, if you remove 3% of the times my losses are more than the double of my normal losses. More than the double of my normal losses. My normal loss is 1.5. Sometimes I'll get double loss. That chances is 3%. 3% chances that I'll get double loss. That is what the point. 3% chances that I'll get double the loss. That is what we have to find. If you look at 1.5 into 1, 1.5 into 1, 1.5% into 1, this will be 0.8413. That means that indicates that 85% of the times my losses are 1.5 or less than 1.5. 85% of the times my losses are 1.5 or less than 1.5. If you look at this 69 or 50, what does that indicate? So 1.5 into 50, that means 0.75%. That means 70% of the times my losses are only 0.75%. 75% of the times my losses are only 0.75%. That is what we have to understand. For the normal 1.5 standard deviation, we have to multiply with Z score. Okay. That how many times? So 97% of the times I am getting losses by less than 3%. Okay, that is what the point. So therefore here you have to understand this 1.5% normal loss. Okay, 1.5% normal loss. Okay, 1.5% normal loss. Sometimes I'll get losses double than that normal loss. Sometimes I'll get less than this normal loss. Sometimes I'll get half of this normal loss. Is there any more fortunate situations where I'm getting only half of the normal losses? Yes, there are fortunate situations. 70 times you are fortunate. 70% of the times you are fortunate enough. You are getting only half of your normal losses. 70% of the times you are fortunate enough. You are getting only half of your normal losses. 0.5 is half of your normal losses. How many times? 70 times. 70% of the cases your losses are half of your normal losses. So 70, it indicates that 70% of the times, the actual problems faced by you is less than 50% of your expected problems. As simple as that. You are expecting that you will face some problems, you will face 10 problems. So 70% of the time, the actual problems faced by you is only 50% of the problem predicted by you. As simple as that. 70% of the times, the actual problems faced by you, the actual difficulties faced by you is only half of the difficulties predicted by you. 70% of the times, the actual difficulties faced by you is only half of the difficulties predicted by you. That is what that indicates. Okay, right. So is there any cases that I have faced problems double than what I have predicted? Yes, what I have predicted. What is that point? 3%. So 3% of the times you have faced double problems than your normal times. 3% of the times you have faced double problems than what you have predicted. That is what. So I am predicting a problem of 1.5%. I am predicting a problem of 1.5%. So therefore 75% of the time, 70% of the times I'll get only half of what I have predicted. I am facing difficulties only half of the difficulties I predicted. Okay, that is what the point. Okay, right. Now, so therefore, if that is the case, 1.5% per day, you should know this problem is basically about how to interpret the jet values. Rather than giving a formula and substituting the figures, they have given these tables to understand how to test you whether do you know the knowledge of interpreting the jet tables or not. Okay, right. Look at this point. They are asking 99%, 99%, 99% means 0.99. 99% means 0.99. Okay, if you look at this table 0.99, it is close to 0.99 is close to where that till now I have rounded it. Yeah, this is the point 0.9901. Close 0. That is the closest figure. That is the closest figure to this is the point. That is the closest figure to 99%. So where that figure is standing 2.3, 2.3 and above 0.3. 2.3 and 0.3, 2.3 and 0.3. So therefore 2.3 plus 0.03, that means 2.33, 2.33, 2.33 into 2.33 into 1.5%, 2.33 into 1.5%. Okay, look at this, 2.33 into 1.5%. Okay, 2.33 into 1.5%. 2.33 into 1.5%. 2.33 into 1.5%. So this is the loss. This is the loss. Okay. So 3% of the time. So 2.3 times. So 3% of the times. 3.5% loss. There is a 1% chances that I'll get 3.5% loss. Normally I am getting 1.5% loss. Normally I am getting 1.5% loss. So sometimes there is 1% chances that I'll get 3.5% losses. Look at this 1.5% standard deviation. 1.5% standard deviation. What does that figure stands for? What does that figure stands for? Normally the loss is 1.5%. Normally the loss is 1.5%. Normally the loss is 1.5%. What does that 3.5% indicates? What does that 3.5% at jet score of 0.9 at 0.99 indicates? It indicates that 1% of the times, 1% of the times, 1% of the times, that is 1 out of 100 years, 1 out of 100 days, 1 out of 100 days, 1 out of 100 days, my losses is 3.5%. Normally my losses is 1.5% per day. Normally the loss is 1.5% per day. Normally the loss is 1.5% per day. Normally the loss is 1.5% per day. Out of 100 days, my losses is 3.5% per day. Say for example, startup companies like all these Flipkarts, etc. Every day they are giving a discount. Every day they are losing 1.5%. But 1 out of 100 days. Say for example, every 3 months they will come out. 1 out of 100 means every 3 months, 90 days approximately. So approximately every 3 months they are coming out with some big billion day or a big Indian festival like that. So once in a 3 months they will come out with some or the other day. In that case, in that day, in that special occasion, they have to give more discount. Therefore, their losses are more. As simple as that. Okay. So there will be some special occasions. Out of 100 days, one day will be special occasion. Like maybe big billion dollar sale or a great Indian festival, whatever the name you call. Out of 100 days, one day will be special day. On that day, we are going to give more discounts. Therefore, my losses will be 3.5%. That is what we have to interpret. So normally my loss is 1.5% per day, but 1 out of 100 days, I am getting my losses of 3.5%. That is what we have to understand. Okay, right. So that is what we have to understand. Normally my losses is 1.5% per day, but every day I am getting 1.5%. Is not that I am getting more than 1.5. Yes, you are getting more than 1.5. We are getting more than 1.5. 3.5% loss you are getting. How many days? 1 out of 100 days. If you look at this point, if you look at the twice, if you look at this twice figure, if you look at this twice figure of 0.997. If you look at this twice figure of 0.997, so this indicates approximately 98% or 2% probability. 2% of the times, 2% of the times, your losses are twice than the normal losses. That means I can like this. Okay, 2% of the times, 2% of the times, that is 2 out of 100 days, 2 out of 100 days. 2 out of 100 days, my losses are 2 out of 100 days. My losses are how much? My losses are 2%. My losses are 2%. Or 1 out of 200 days, 1 out of 200 days, my losses are 2%. Anyway, you can take. Anyway, you take this. So 2% of the time, that is 2 out of 100 days, my losses are 2%. Normally, my losses are 1.5% per day. That is what we have to interpret. That is what we have to interpret. Look at this point. So if I take this 0.6915, what does that indicates? 70% of the times the losses are my actual losses are 50% of what my predicted. That 0.5 and that 0.69. I'm taking it as 0.6915. 0.6915. So what does that indicates? What does that indicates? Okay, 50% of the times, 50% of the times, 50% of the time, 50% of the times, 50% of the times, my losses are only, sorry, right, 70% of the times, 70% of the times, my losses are only half of what I have predicted. Half, 0.5, 0.5, that is half. That is half of what I have predicted. Of what I have predicted. Unnecessarily I am worrying. That's it. Half of what I have predicted. As simple as that. 70% of the times my losses are only half of what I have predicted. That is what that point says. 70% means I have rounded off this 0.69. That means you can take 7 out of past 10 question papers. 7 question papers is actually half difficult than what I have predicted. Normally, we will be predicting that difficult question paper is a question paper where 50% of the question paper is not possible to attempt. So out of that is happening, only half of it is lifted. Say for example, if you thought that out of 100 marks paper, out of that 100 marks paper, out of that 100 marks question paper, look at this. Out of 100 marks question paper, say for example, 60%, 60 marks is difficult. 60 marks is difficult. 60 marks is difficult. What we have predicted. This is what our prediction. This is what our worry. This is the worry of the students. This is the worry of the students. Okay. Worry of the students. Out of 100 marks, they are thinking that 60 marks may be difficult. So this is happened. This is happened 70% of the times. Out of past 100 question papers, out of past 10 papers, out of past 10 question papers, out of past 10 question papers, 70%, that is 7 question papers, that is in 7 question papers, in 7 question papers, in 7 question papers, in 7 question papers, the difficult questions are only 30%. The difficult questions are only 30% of. That means what is 30%? 60% of my worry. 60% is my worry. I have worried about 60% difficult marks. I worried that out of 100 marks question paper, 60 marks is difficult, but I am getting only 30 marks as difficult. If I look at that past, 30 marks as difficult. Okay, ma, this is what you have to understand. So 0.5, 0.69, that means 0.69. What does that indicate? Normally, I am predicting this 60% marks. So I am predicting that 60% of the question paper will be difficult. Normally I am predicting that 60%. I am worrying about. A student is worrying that 60% of the question paper will be difficult. But if you look at the past 10 papers, say out of 7 papers, the difficult questions are only half of what we have predicted. That means unnecessarily we are worrying. As simple as that. This is what is statistics. This is what is statistics. Okay. Most of the times our difficulties may not actualize. Unnecessarily we are happening. Somewhere when I'm in CA final in 2011, I read one quotation which says that 9 out of 10, if there are 10 problems coming down the road, 9 will run into the reach before they reach you. That is what the quotation has said. If there are 10 problems coming down the road, if there are 10 problems coming down the road, 9 will run sideways before they reach you. Unnecessarily we are worrying. Just I'm giving an example. So therefore this 0.69 indicates that 70% of the times, whatever difficulties we have predicted, only half of the difficulties will happen. Unnecessarily we are worrying. As simple as that. That's what the statistic says. But there are three times the question paper is, if you look at this point, if you look at this our present price 2, if you look at 2, 0.5, I'll take this 2, and besides that 0.977. 0.977, how much? 0.9772. That is, I can take 98%. So 98% I can take. So 98% of the times, or I can better understand 2 times. So there is only 2% of the times, only 2% of the times, only 2% of the times, my losses are twice than what I have predicted. Only 2% of the times my losses are twice than what I have predicted. That means if I take this point, if there are out of past 10 question papers, 2%, out of past 100 years question papers, I can take out of past 100 question papers. That means 50 years, right from the beginning of the CA Institute. right from the beginning of the CA Institute, out of 100 question papers, that means 50 years, out of 100 question papers, 2%, that is two question papers, the difficult questions are 120 marks. Sir, how come 120 marks including choice? How come 120 marks are including choice? That means out of CA history, only two times the entire question paper is difficult. Remaining time, 70% of the times, only half of the question paper is difficult than what we have predicted. So if we have predicted that 60% is a difficult question paper, but the actual difficulty is only 30 marks. So 70% of the question papers, only 30 marks question paper is difficult. Remaining question paper is easy to solve. Okay, out of past 10 question papers, this is what the statistics I am saying. I'm not discussing about the real CA question papers. So if you apply this example to our CA question papers, the statistics implies that out of 7 out of past 10 question papers, if you look at this, the difficult marks are only half than what we predicted. If you predict that the difficult marks is 60 marks in the exam, the actual difficult questions is only 30 marks. If you predict that 60% of the questions in the exam are difficult, but the actual difficult questions is only 30 marks. See, 70% of the time it is happening. 70% of the time, the actual difficulty of the question paper is only half than what we have read. 70% of the time, the actual difficulty of the question paper is only half of what we have read. This is how we have to interpret. This this standard. Okay, man? So therefore, I want that 99%. I am 99% confidence. 99% confidence. Therefore, since it is closer to this, I can take exact figure somewhere in between 2.2 to 2.3. I can take it 2.22, 2.2 plus 0.02, 2.2 plus 0.02, 2.22. So 2.22. I can take some approximate figure, but that is not necessary because the question is only for 4 marks. We don't need to go for the accurate figure. We can go for the approximate figure. 0.9901, close to that. 0.99 close to that. Look at that. In the examination question paper, some error is there. They have taken it as 0.9988. This 2 error. Actually, it is wrong. That figure should be 9898. That figure should be 9898. That figure should be 9898. This should not be the figure. That figure should be 9898. That figure should be 0.9898. 0.9898. The figure should be 0.9898, not 0.88. Printing error. If you look at the original jet tables, this is what the point. 0.9898. Okay, so this is the 90 to 99. This is the close figure. I can take the difference between these two. I can do the interpolation, but for that 4 marks, that is not necessary. You'll get the say approximately same answer. So therefore, according to me, you don't need to waste your time to get the interpolation for this. Go back to your internal rate of return, and many times you have taken the interpolation for bond valuation, etc. We can do that. If you have the time, you can do it. But according to that, is not necessary. You'll get the same answer, approximately same answer. Okay, I am taking this figure average 0.9901. That means where that 0.9901, it is from 2.3 to 2.003. That means 2.3 plus 0.03. That will be 2.33. It will be 2.33. This is the jet score. Normal problems till now, the previous exam problems we have seen, wherever value at risk is asked in the previous exam problems, they have straight away given this jet score. And this problem is testing you whether you know how to read the jet table or not. Till now, you might have seen the problems where the jet score is directly given in the question, but this is the problem which is testing you whether you know how to interpret the jet score or not. Okay, jet score is 2.33. So therefore, I'll write this formula: value at risk. I will write value at risk is equal to my investment amount into standard deviation into jet score. Standard deviation into jet score. Okay, this is what the normal formula. So this jet score we got now 2.33. This is jet score we got 2.33 now. So now the point is they are giving this value at risk. They have given this value at risk, and they want you to calculate this. This is given. Value at risk is given. Indirectly, they have given the hint to compute the value at risk, and you have to compute this investment. Just by interchanging the formula, you can compute it. Sir, what is the value at risk? Look at this. What is the value at risk they have given? The investor desires to make a maximum possible investment where value at risk should not exceed the balance lying in his bank account. Value at risk should not exceed the balance lying in his bank account. What is the balance? What is the balance? Though 7 lakhs is the balance lying in his bank account, but available balance is only 6,99,000 because 1,000 is minimum balance. You cannot utilize it. 1,000 is the minimum balance. You cannot utilize it. That means whatever is his present assets, he was ready to forego the present assets. Whatever the present available cash balance, 6,99,000. Up to that amount, he was ready to bear the loss. That means he was ready if he loses the entire amount also. But he don't want to borrow. That's it. That means he doesn't mind even if he loses his entire bank balance also. He don't want to do any debt. He don't want to borrow any money. That is what his expectations is. Okay, ma? Right. So if that is the case, 6,99,000 is my loss. 6,99,000 is my loss. That is the first figure we have to calculate. And the 6,99,000 is my loss for 4 years, boss. 4 days, not for single day. From Tuesday till Friday. Tuesday, Wednesday, Thursday, Friday, 4 days. My value at risk. So the 6,99,000 is value at risk of 4 days. The 6,99,000 is value at risk of 4 days. So therefore, I need to calculate investment amount. I need to calculate investment amount. So value at risk of 4 days is equal to value at risk of 4 days is equal to value at risk of 1 day into square root of 4. That is what the formula, value at risk of 4 days into 1 square root of 4. Go back, go through my material. I have given the formulas there. T days, value at risk of T days is equal to value at risk of 1 day into square root of T. How many days? So this is what the formula. So this is what 6,99,000 we got. This value at risk of 6,99,000 we got. Total loss for 4 days. 6,99,000 total loss for 4 days. Okay. Value at risk. What is the formula for value at risk? Investment amount into standard deviation into Z score. Into Z score. Into the square root of 4. That means 2. Square root of 4 means 2. Right, now we'll calculate 6,99,000. 6,99,000 investment amount we don't know. That is what we have to calculate. Standard deviation is 0.1015. 1.5% into Z score is 2.33. Into Z score is 2.33. Into Z score is 2.33 into 2. As simple as that. Substitute it in the formula. Substitute it in the formula. Therefore, I'll calculate 6,99,000 into is equal to I into, we have to multiply those figures. We have to multiply those figures. What are those figures? 0.15, 2.33, 2.33. How I got this smart 2.33? You can write working note for this. So how I got this 7 lakhs, 6,90,000, 7 lakhs minus 1,000. 7 lakhs minus 1,000. How I got this 2.33? 2.3 plus 0.03. 2.3 plus 0.3, 2.33. So 0.015, 2.33 into 2. I need to multiply all the figures. 2.33 into 2. So if I multiply all those figures, you'll get 0.69, 0.69. You will get 0.69699. You will get 0.699. If I is equal to 6,99,000 divided by 0.699. 6,99,000 divided by 0.699. Okay, ma? Right. So what is the investment now? What is the investment now? 0.699. 6,99,000 is my value. Okay. 6,99,000. So 6,99,000. I got 6,99,000 divided by this. So this will be how many zeros? 6,99,000, correct ma? This one 6,99,000. 6,99,000. 6,99,000. 0. Sorry, this is 0.015. 0.015. 0.015. So 7 zeros. 7 zeros means 1 crore amount. 1 crore amount. That means I can invest 1 crore. On that I may lose 7 lakhs. 6,99,000. Even it doesn't matter. That means 1 crore I can invest. 1 crore I can invest. Okay. That is what the point. So therefore investment is 1 crore. Therefore the required investment is 1 crore. Therefore the required investment is 1 crore. This is what the point. So therefore this problem is mainly focused on how to interpret the jet tables. This is the formula. You should be very cautious. They have given Tuesday to Friday 4 days value at risk, but this is 1 day value at risk. This is 1 day value at risk because the standard deviation is given per day. Therefore, by using that, we can calculate only 1 day value at risk, not for 4 days. We can calculate 1 day value at risk only, not for 4 days. So therefore 1.5%. So therefore I need to I need to write this formula. 4 days value at risk is equal to value at risk of 1 day into square root of 4. So 4 days, Tuesday to Friday, 6,99,000. How that, even though I have 7 lakhs balance, but 1,000 minimum balance I should keep, I can do 6,99,000. Okay, that next investment amount we don't know. Standard deviation they have given 1.5 and the jet score 2.33. That means this 0.99. This indicates that if you multiply only these two, this is the right information we'll get. If you multiply only these two, and if you get this 3, that is what we have got about, right? Right. So this is what the point. So that means what is this point? Out of 100 trading days, out of 100 my normally my loss during any trading day, my loss during any trading day is 1.5% per day. Is 1.5% per day. Normally, my losses during any trading day is 1.5% per day. So maybe I am doing intraday. Okay, normally my losses during any trading day is 1.5% per day. But out of 100 trading, so here 3.5%. 1 out of 100 trading days, my losses may be 3 or 3.5%. That is what they are indicating. Normally, Flipkart losses are 1.5% per day of their investment. But out of 100, 1 out of 100 days, that means every 4 months they will come out with some festival occasion sale, a big discount sale, and that big discount sale, their losses will be 3.5. Based on that, they will get funding. Okay, man. Right? This is what the point. Okay. So you should interpret this. What does that 3.5 stands for? So even though our answer is 1 crore, this 2.33 into 0.015, 3.5, and that 0.99. So what does these two indicates? 99% of the times my losses are 3.5% or less than 3.5%. Only 1% of the times my losses are more than 3.5%. I can write like this. Okay, 99% of the times. So 100 out of 99 out of past 100 days, 99 out of 100 trading days, my losses are 3.5% or less. 3.5% or less. Only in 1 out of 100 trading days, my losses may exceed 3.5%. That is what the point. Okay, this is how the question has to be interpreted. So the problem, in this problem, we should be careful about. First point is jet score, identification of jet score. Okay, so maybe some students may be easy to catch this 0.99, and they can take the 2.3. And the probable mistake is taking entire 7 lakhs. That is not correct. We have to deduct 1,000. And maybe they are taking 1 day. The possible mistake that straight away they can take it. No, that is a wrong answer. The 4 days they have given, Tuesday to Friday. So therefore I have to take 4 days value at risk. This is what my answer. Value at risk of 4 days is equal to value at risk of 1 day into square root of 5. Value at risk of 1 day is equal to, this is the formula. This is given, they have 6,99,000. They have given value at risk for 4 days. Investment amount we need to calculate. Standard deviation per day they have given. Jet score we have calculated by looking at the table, and the square root of 4 will get the 2 points. So therefore my investment amount is 1 crore. So I can invest 1 crore. My investment amount is 1 crore. Come on, this is 1C. In the next video, we'll come out the next problem. Come on, see you, ma.